This is Bill Scheid from Applied Finance Research, and in this video we're going to cover 6 important backtest biases to avoid. The first one up is look-ahead bias. Look-ahead bias is using future information that wasn't actually available at the time of trading. And a great example of this is using a stock's end-of-day price to simulate an intraday trade. Another example would be if you created an intraday system that bought at the low of every day and sold at the high of every day, but of course we don't know what the low and the high of the day is until after the day has closed. If you do that, the impact is going to be you're going to have wildly unrealistically good performance because your system is cheating by knowing the future. The next bias up is survivorship bias, and this is only including assets that still exist and ignoring those that disappeared, failed, or went out of business along the way. An example would be if you run a test only on current S&P 500 members, for example, or Dow Jones Industrial Average members, for example, but you don't include the ones that fell out of the index or went out of business along the way. Again, the impact of this is it's going to overstate performance because it excludes past losers or past failures or past underperformers. The next bias is selection bias, and that is choosing specific data or assets that highly favor the strategy. So in essence, this is cherry picking. And an example here would be only testing tech stocks during the dot-com bubble. So of course, you're going to get great results, but they are misleading and not representative when we think about taking a broader sample. The next bias up is data mining bias, and that's searching through many variables or strategies until you find one that fits the past data. So an example would be testing thousands of different moving average combinations until finding one that works. And the result of that is that you get kind of spurious, random, non-relevant results that are way overfit, and they don't have any real power going forward. The next bias is over-optimization. So that's tuning parameters excessively to maximize performance over past data. And essentially what we're doing there is we're fitting to noise instead of to signal. So an example would be fine-tuning stop-loss levels, fine-tuning look-back periods, fine-tuning indicators, and doing that with a huge number of degrees of freedom. That means a huge number of variables would allow you, of course, in past data to pick every bottom and pick every top, but the long-term impact is that the system will fail on out-of-sample data because the future is never exactly like the past. It may rhyme, but it's not exactly the same. And the sixth bias to avoid is path dependency bias, and that is relying only on the single historical sequence of trades that a backtest gives you without simulating alternate sequences. So an example here would be not running Monte Carlo simulations to explore how big drawdowns can actually be. And the impact here is that this underestimates risk and ignores the variability of other possible paths, so it doesn't give you a true representation of the range of possible performance of your systems. This is Bill Scheid from Applied Finance Research. Thank you very much for watching, and happy investing.